Hey, it's Joe Crump. One of the most important aspects of real estate investing is choosing the right property to invest in. This is where most people screw it up. Whether you're just getting started flipping property or an old hand looking to expand your portfolio, selecting the perfect investment property can make or break your success in real estate. And like in basketball, as soon as you stop paying attention to the fundamentals, which in real estate investing is finding good property, your business will take a hit. The right property can generate consistent cash flow, appreciate in value, build wealth over time. They'll also give you tax depreciation savings, and your tenants will buy down your mortgage for you over time. On the flip side, choosing the wrong property can lead to financial stress, tenant issues, slow or negative returns on your investment. In this video, I'm going to guide you through the key factors you need to consider when choosing an investment property. We'll cover everything from location to market trends, and I'll share some of the real life examples to bring these concepts to life. By the end of this video, you'll have the knowledge and tools to confidently select properties that align with your investment goals. So let's get started. The first step in choosing the right investment property is understanding the key fundamentals that influence a property's potential. Let's break down the most important ones. One, location, location, location. This is the golden rule of real estate for a reason. The location of your property will largely determine its rental demand, resale value, and overall return on investment. When evaluating a location, consider the proximity to amenities like schools, public transportation, shopping centers, and job opportunities. A property in a desirable location will attract more tenants, reduce vacancy rates, and command higher rents. Additionally, look at the neighborhood's long-term potential. Are there signs of development or gentrification? These can be indicators of future property appreciation. Two, property condition. Next, consider the condition of the property. A property that's in good condition requires less upfront investment in repairs and renovation, which means you can start generating income sooner. However, don't automatically dismiss properties that need work. Often a fixer-upper can be purchased at a lower price and, with the right improvements, yield a higher return. Just be sure to accurately assess the cost of necessary repairs and factor that into your budget. Three, market trends. Understanding market trends is crucial for making an informed investment decision. Research the local real estate market to identify trends in property values, rental rates, buyer demand. Is the market growing or declining? Are the rents rising or stabilizing? Knowing the answers to these questions will help you gauge the future performance of your investment. Also, consider the economic factors influencing the area, like job growth, population growth, infrastructure development. All these can impact the property's value over time. You should also consider long term growth in this equation. I currently buy in several areas, but the one I concentrate on the most is Indiana. Indiana has grown in value by 300% over the past 30 years. That works out to about 10% a year consistently, more or less, for 30 years. I love the consistency and stability of owning long term investment properties in an area like this. We have a done for you program for people who would like me and my company to build your Indiana portfolio for you. We do everything. Our goal with these investments is to take $200,000 and turn it into $100,000 passive income per year after 10 to 15 years, and turn that $200,000 investment into 1.5 million in equity over that same period of time. If you want more information about this program and how it works, and a breakdown of all the numbers of how we do it, go to jr4.co/done for you. Number four, rental demand. If you're investing in a rental property, rental demand is a crucial factor. Research the local rental market to understand the types of properties that are in demand, whether it's single family homes, apartments, or commercial spaces, two bedroom, three bedroom, four bedroom. High demand means you're more likely to find tenants quickly and minimize vacancy periods, ensuring a steady income stream. So, how do you go about finding the right property? Luckily, there are plenty of tools and resources available to help you research and analyze potential investments. Online property listings, websites like Zillow, Redfin, Realtor.com are excellent starting points for finding available properties. These platforms allow you to filter properties by price, location, size, and other criteria, making it easier to narrow down your options. You can also set up alerts to notify you when new properties that meet your criteria are listed. Number two, heat maps and market analysis tools. To get a better sense of the local market, use heat maps and market analysis tools like Mashvisor or Roofstock. These platforms provide valuable insights into property values, rental rates, and neighborhood trends. Heat maps can show you areas with high rental demand or where property values are appreciating, helping you make more informed decisions. Number three, financial calculators. It's essential to crunch the numbers before making an investment. Use financial calculators to estimate your potential returns, including cash flow, cap rate, and return on investment. These tools can help you compare different properties and determine which ones offer the best financial outlook. I use an old Hewlett Packard 12C business calculator. I've been using it for more than 30 years, and it's like a third hand to me. But you can also get loan amortization apps online with a simple Google search. Eventually, you'll be able to do a lot of guesstimating of these numbers in your head. Number four, local resources. Don't forget to tap into local resources such as property tax assessors' websites and city planning departments. These sources can provide information on property taxes, zoning laws, and upcoming developments that could affect your investment. Additionally, consider working with a local real estate agent who has in depth knowledge of the area. They can offer insights that you might not find online. You can also hire us to do everything for you. The amount you want to be involved will determine your strategy. Many of you want to learn how to do this yourself and run your own real estate empire. Others have sources of income outside real estate and just need a way to quickly secure that investment money so that they can get a better return than securities and stocks. Once you've identified a few properties that meet your criteria, the next step is to analyze their potential returns. This is where you'll determine whether a property is truly a good investment. Number one, cash flow analysis. Start by calculating the property's cash flow. Cash flow is the amount of money you'll have left over each month after covering all your expenses, including mortgage payments, property taxes, insurance, and maintenance. A positive cash flow means the property is generating more income than it's costing you, which is a good sign. Negative cash flow can eat you alive. Be very careful to avoid negative cash flow unless you have the resources to cover it until the rents or income come up enough to cover it. To calculate cash flow, subtract your total monthly expenses from your total income. You want a property with a strong positive cash flow, as this will provide you with steady income and financial stability. The more money you put down, the more your cash flow. Sometimes it makes sense to take a small negative in order to keep your cash in the project low. This, in turn, can give you a great return on your investment, even though you may have money coming out of your pocket every month. But it's vital that if you take a negative on your property, that you're able to support it. That means you have reserves. Number two, cap rate. The cap rate or capitalization rate is another important metric. This is probably more useful for commercial property than residential property. The cap rate measures the property's annual return on investment expressed as a percentage of the property's value. To calculate the cap rate, divide the property's net operating income, NOI, by its current market value. A higher cap rate indicates a higher return, but it's important to compare the cap rate to other properties in the area to ensure it's competitive. Cap rates tend to be very local, so knowledge of your local market is important if you're using cap rate as a metric to value your properties. Number three, return on investment, ROI. It's a much more comprehensive measure of your investment's profitability. To calculate ROI, divide your total profit, including cash flow and any appreciation, by your total investment, including the purchase price, closing costs, and any renovation expenses. ROI gives you a clear picture of how much money you're making relative to the amount that you've invested. When comparing properties, look for those with the highest ROI. The cheapest property is not always the one that will give you the best return. You can buy property at full market value and still make a higher return than a property you purchased substantially below market value, but needs a lot of work. These are the kinds of analysis we do for our investors in our Done For You program. Number 4, the break-even point. Finally, consider the break-even point. This is the time it takes for your investment to pay for itself. This is the point at which your income from the property equals the total cost of the investment. The shorter the break-even point, the less risk that you're taking, because that's when you'll start seeing profits. To calculate the break-even point, divide your total investment by your annual cash flow. By carefully analyzing these metrics, you can make informed decisions and choose properties that align with your financial goals. Remember, the key is to balance potential returns with the risks involved and to ensure that the property fits within your overall investment strategy. You also need to decide if you're looking for short-term or long-term investments. Do you want short-term flips, cash in your pocket today, more work, less passive, or long-term hold? If you wait, you will win. This is what makes you wealthy. Less work, more passive, more time. To bring all this together, let's look at some real-life examples of successful investment properties. These case studies will illustrate how the factors we've discussed play out in the real world. Example 1, the fixer-upper success. Let's start with a property that was purchased as a fixer-upper in a developing neighborhood. The investor bought the property for $150,000 and spent $30,000 on renovations. After the renovations, the property was valued at $220,000. With a monthly rental income of $1,800 and expenses totaling $1,200, the investor enjoys a positive cash flow of $600 per month. The cap rate is 8.2%, and the ROI after 1 year is an impressive 25%. This property was a great investment because the investor correctly identified an undervalued property in an area with higher rental demand and growth potential. Example 2, the turnkey rental. Next, consider a turnkey rental property in a stable working-class neighborhood. This property was purchased for $200,000 and required no renovations. The investor receives $1,500 in monthly rent, with expenses totaling $1,000 per month, resulting in a positive cash flow of $500. The cap rate is 7%, and the ROI after 1 year is 15%. This is on an all-cash investment. If you leverage your money, you can get 3 or 4 times this return. This property was a solid choice for a more conservative investor looking for steady, predictable returns without the hassle of renovations. The key takeaway here is that not every successful investment needs to be a high-risk, high-reward scenario. Sometimes a stable, lower-risk property can be the perfect fit for your portfolio. Example 3, the commercial property play. Lastly, let's look at a commercial property investment. Commercial properties have their own complexities, and I'm not going to cover them here very much, but we do commercial, and I thought I'd give you an example of one. We purchased a small 23-acre industrial site for $330,000 in a busy downtown rural area. The property had several old buildings that we repurposed into RV and boat storage. I invested another $500,000 into the property over the following year as we built out the facility. After accounting for expenses like property taxes, insurance, maintenance, we net about $7,000 per month in cash flow income from the rental of those units. This gives us a 9% return on investment. But we also built approximately $1 million in equity on the investment, which skyrockets our return since it more than doubles our value. This one has not been a passive investment. It's an ongoing project, and we're constantly talking about it with my mentor group. We keep finding new ways to monetize this facility and improve our return. We're hopeful that this project will be worth $7 million based on income within the next 4 years without much more investment from me. When you're doing projects like this, it's so valuable to have a mastermind group you can take it to, investors with a lot of experience and knowledge. I've been very fortunate to create that group through my mentor program, and it's allowed me to continue to work with experienced investors and bring in newbies as well. I find that constantly training new investors reinvigorates the old, worn out investors like me and gets them excited again. All right, then. These examples show that there's no one size fits all approach to real estate investing, whether you're looking at residential or commercial properties, turnkey investments, or fixer uppers. The key is to carefully analyze each property and ensure it aligns with your financial goals and risk tolerance. I put out multiple videos that are deal dissections. I break down the minutia of real world deals we've put together for ourselves and our investors so you can see exactly how much we have in the deal, whether we used cash, seller financing, or conventional financing. I also break down how to calculate returns when you leverage your investment. You can also see how we break down investment properties for our Done For You program here at jr4.co/done for you. Well, there you have it, an overview of how to choose the perfect investment property. Remember, the right property can set you up for financial success, not only for yourself, but for your heirs. We're talking about building generational wealth by building a passive portfolio. But it all starts with thorough research and smart decision making. If you found this video helpful and would like me to make more of them, make sure to give it a thumbs up and share it with anyone who might benefit. And don't forget to subscribe to our channel on the button below. And if you'd like more tips and real estate investing strategies, you can also subscribe to my free email newsletter. I send out information, tips, and deals to this list that I don't send out to anyone else. Go to my blog at joecrumpblog.com and opt in there. One last note I want to leave you with. As an investor, you should always try to be the most ethical person in the room. Take care of your buyers and sellers and employees like they were your family.